Hi, and welcome to the 2015 Spring Tour presentation for the Montana University System Choices Benefits Program. My name is Connie Welsh. I'm Director of Benefits for the Montana University System. And today what we're going to be doing is going through your Choices program for the fiscal year 2016 plan year. That year starts on July 1st of 2015 and runs through June 30th of 2016. So today what we will be talking about are important changes for 2016. We will talk about medical benefit enhancements. We will talk about flexible spending account changes and tax advantaged account changes. These are two of the biggest changes for the new plan year. The introduction of the new tax advantaged account is particularly of interest to employees. So we encourage you to plan to attend one of the live benefit presentations on your campus and be willing to ask questions and hear what other employees have to say or ask about the new tax advantaged accounts. And then finally we'll talk about the wellness incentive as well as how to make your benefit elections this year and any other information that you need. So let's get started with the medical plan changes. For this year we have some enhancements to the medical benefit changes in two categories. Those are in what are called the complementary health care services and the miscellaneous benefits. So for those folks who are interested in the acupuncture, the naturopathic, and the chiropractic benefits, please note that we now have a change. We have a $15 copay, and our visit limit is now an annual limit of 30 visits in each of those categories. We're also introducing a new massage therapy benefit, which will have a $15 copay and a $30 annual visit. Note on the naturopathic benefit, there is no 30 visit limit this year. And the reason is because those are considered equivalents to medical visits of a non-naturopathic physician, and so the benefits are equivalent. We also have enhancements to miscellaneous services, which are dietary and nutritional counseling, obesity management, TMJ services, and infertility treatments. Those have an out-of-network benefit now with coinsurance of 35%. Because some of these complementary healthcare services do not have a network, please be aware that there may be a difference out-of-pocket charged if the charges from the provider are greater than the allowance for your medical plan carrier. We will continue to offer in 2016 three choices of plan administrators. Those are Allegiant Benefit Medical Plan, Blue Cross Blue Shield of Montana, and Pacific Source Managed Care. So please take a look at those rates in your booklet or online, and take a look particularly at the networks of providers and determine which one of those individual carriers has the network of the providers that you and your family use. If you do not know whether or not one of the providers that you and your family use are in network, please be sure to call either the carrier, Blue Cross, Allegiance, or Pacific Source, or you're welcome to call the main MUS Benefits office and we will help you. One other note on eligibility too. Please be aware that dependents up to age 26 may be added to your benefit plan beginning this year. Every year you get the option to add children up to age 26 to medical, dental, and vision benefits. This does not include spouses and adult dependent partners. So be aware that children can be added up to age 26, but not other individuals without what is known as a qualifying event. Proof of eligibility according to the summary plan document will be required. All right, so one of the big changes that's coming this year are to flexible spending accounts. For those employees who have been with us for some time, you will recall that in 2012 and 13 there were changes to the flexible spending account. We used to be able to put $6,000 in a flexible spending account, and then in the 2012-13 plan year that amount reduced to $2,500, and it's remained at that level since. Those changes were a result of continuing implementation of the Affordable Care Act. The Affordable Care Act began in 2010 and implementation will continue through 2018. So this is another one of those phased-in components of implementation. So how does that impact the flexible spending accounts coming up July 1st of 2015? Well, beginning with that plan year, which is the fiscal year 2016 benefit plan year, there are two important changes. Most folks are aware of the fact that the employer contribution, which is also called the state share, and which is $887 per employee currently and will remain at $887 for the upcoming plan year, is used for employees to purchase benefits. And then if the amount of the benefits that you purchase is less than $887, historically what we have been able to allow employees to do is place that difference in a flexible spending account. We are no longer able to allow that. The second change is that the maximum amount that an employee can deposit in a flexible spending account will change from the $2,500 level that it has been since fiscal year 2013. It will increase by $50 to $2,550 beginning July 1st. So what does that mean? Okay, it means that we had to think about a new way to offer benefits and offer tax-advantaged medical spending accounts to our employees. Flexible spending accounts are now more limited. As I just explained, the manner and the amount that can go in of employer contribution has changed under the Affordable Care Act. So now we are going to be offering two accounts. Flexible spending accounts, medical flexible spending accounts, will still be available for employees. However, there will be two important changes. As I mentioned, the amount will go up to $2,550 per year. But the source of the contribution will now only be from employee funds. So if you elect to have a portion of your paycheck set aside on a tax-free basis to go into the flexible spending account, that is the sole source of funding beginning July 1st of 2016 for a medical flexible spending account. So you can still put aside $2,550 in fiscal year 2016. So that's a major change to the medical flexible spending account. We are adding a new account. This account is called a tax-advantaged account, or a TAA. This account works much like a medical flexible spending account, but under IRS rules it doesn't have some of the same restrictions that the FSA now has. In particular, it can only be funded through employer contributions, so beginning July 1st, the Montana University system will place $750 in a tax-advantaged account for every employee, regardless of whether you are only covering yourself as a single employee or whether you also cover family members and dependents on your plan. The same allowable expenditures can be made out of a TAA as can be made from a flexible spending account. So the same things that you can use for reimbursement out of an FSA can come out of a TAA. There are some important advantages, however. A TAA does not have the same use it or lose it requirements a flexible spending account has. That's a big deal. So that permits the employer to place funds in this account, and if you as the employee do not have to expend or choose to expend anything out of that account this year, those funds are not forfeited. They will roll over for a subsequent year. All of the funds, not just a portion of them like the flexible spending account. The account balance is also portable upon termination of the employee. So let's say an employee leaves and goes to another job, or maybe an employee retires, they can still have that balance that remains in that account. The balance will remain in the account for 24 months following the end of the month in which they actually left employment, and will be available for reimbursement on a tax-free basis of qualified medical expenditures. So here's a little bit of detail about tax-advantaged accounts and how they differ from SSAs, things that we want you to be able to take advantage of. And you may want to talk to an accountant or a tax advisor depending on what your family's particular circumstances are, because there are some restrictions within households, though they may not be specifically things that come from your employment through the MUS and your elections through the Choices program. Those include these kind of items. As I mentioned before, only employer contribution funds can be placed in a tax-advantaged account. If you wish to make a contribution out of your paycheck, you will have to make that election and use a flexible spending account. If your spouse, through another employer, has a health savings account or participates in a high deductible health plan, as I mentioned, you might want to talk to an accountant or to another tax advisor about your household situation. Typically, if one member of a household has an HSA or a high deductible health plan, then other members of the household are not permitted to have a tax advantaged account or a non-restricted flexible spending account that reimburses full medical expenses. So please check with a tax advisor. It's hard for us to give you advice right now because we don't know your specific situation for your family, so that's something that you will need to talk through with someone. For that reason, employees must elect annually whether or not they want the tax advantaged account or not. That's the reason we're asking you to elect the TAA, because we do not want to automatically open an account if it would cause some difficulty in your household given your particular benefit structure and your tax situation. The tax advantaged account will be funded for fiscal year 2016. We have funds currently to do that, and we will be reviewing annually what our financial situation is within the MUS Choices program to determine whether or not we will be funding tax advantaged accounts in future years. The account balances, as I mentioned, are not use it or lose it, but they are not in perpetuity. So there are two situations. If you are an employee who leaves, as I mentioned before, either goes to another job or retires or for some other reason leaves employment with the university system, you'll still have access to your tax advantaged account balance for 24 months following the month in which you left service with the university system. If you are an active employee, and as I mentioned, we're reviewing whether or not we are funding tax advantaged accounts, if at some point we cease to fund the tax advantaged accounts, and that includes either a explicit employer contribution such as the $750 contribution we're making this year, or wellness incentive funds, then the account balances will need to be used by active employees within 24 months of the last month in which we make an employer contribution in some manner. We will keep folks apprised of that, and we'll let you know what the time frames are if we get to that point, but as we mentioned, we'll be reviewing annually to see if we can fund the accounts and how long we can continue to provide this new benefit for employees. Those last slides have a lot of words on them. So I don't know about you, but I am very visual. So some folks learn from reading, some folks are more visual. So here's another way to think about the old model of medical spending accounts or flexible spending accounts in the new way. So in the old way, we had one bucket. Everything went into the bucket, whether it was money that you, as the employee, set aside directly from your paycheck, or whether it was excess state share that was left over from your benefit elections and rolled into the flexible spending account. And then finally, the third way of doing this was to go ahead and have the wellness incentive if you participated in our wellness program and qualified for the $250 or $500 wellness incentive. Those funds in the current year are placed in an FSA beginning July 1st. The wellness incentive funds will go into the tax advantaged account. One other thing to mention are the fees on FSAs and the tax advantaged account will be paid by the MUS plan and not by the employee during the fiscal year 2016 plan year. But this is what the new arrangement looks like. That was the old, this is the new. So now you have an option of either or two buckets. So that if you want to continue with a medical flexible spending account, you're certainly welcome to do that. Your funding for the medical flexible spending account will come entirely from deductions out of your own paycheck up to $2,550. The tax advantaged account will have $750 in the fiscal 2016 plan year of employer contribution. Again, that's an IRS requirement. It can only be employer contribution. In addition, as I mentioned, if you qualify for one of the wellness incentives through MUS Choices, the $250 or $500 wellness incentive will be placed in the tax advantaged account as well. Be very careful to remember that you have to elect each of these options. So you may need to make a positive choice to say, yes, I want the tax advantaged account, and yes, I want an FSA if you so choose, and how much you want to put in FSA. A little bit about the wellness incentive. We're continuing with the MUS Wellness Incentive Program. Active employees who completed a well check, and that includes a biometric screening, a health risk appraisal, and a blood draw during 2014. So that's either spring well check of 2014 or fall well check or both. And you achieved the Trailblazer level, will receive a $250 wellness incentive contribution to their tax advantage account. If the employee completed the Trailblazer level and they also had an adult dependent on the plan who went to a well check, then you can have an additional $250 up to a maximum of $500 for your household placed in a tax advantaged account. A little bit more on FSAs. You may recall that last year we had a change to the flexible spending accounts. We're back to the medical flexible spending account, and we permitted a $500 rollover. So if you got to June 30th and you had not claimed all of the funds in your account, you could roll over up to $500 into the next plan year. There's a reconciliation process that happens as we go through and settle claims out through the end of 2015 plan year, which goes through June 30th. So we complete that reconciliation, and then if you have up to $500 left over, that can be placed in your flexible spending account should you elect one for the fiscal year 16 plan year. We will place that in October of 2015. Again, these funds can be used on any qualifying medical expenditures during the following plan year from your FSA. So as you can see, you can put up to $2,550 of your own money in a medical flex. You could put another $500 if you had rollover funds from the current year left over. Then in the taxable tax advantage account, you'll have a $750 employer contribution plus either $250 or $500 for participation in the wellness program. What we're trying to do is encourage people to take steps to maintain their health and to help them pay for routine medical care. So if you have the ability to take advantage of some of these programs, it can significantly reduce your out-of-pocket expenditures for things like deductibles, copay, and co-insurance. All right, new topic is life insurance elections. Evidence of insurability is when you have to present to our carrier, the standard life insurance, information that says you are insurable for life insurance. Those situations are for an active employee who would like to add optional supplemental life insurance in an amount above $300,000, or if you would like to increase coverage more than $25,000 this year. You will have to go through their evidence of insurability process. In addition, if you want to add optional supplemental dependent life for a spouse for any amount, you will have to do that unless you are a new hire employee and you're going through the new hire process. That's the only time when you won't have to do evidence of insurability at this time. Optional supplemental life and optional accidental death and dismemberment coverage premiums are paid on an after-tax basis. The reason we do that on an after-tax basis is the IRS permits us to either pull premiums that are taxed or benefits are taxed. So as you can imagine, premiums generally in most cases are going to be less expensive and the tax burden would be less than if you actually have a benefit payout and that full amount is taxable as a lump sum. That's why we tax these amounts on premiums pre-tax, is to preserve the greatest amount of benefit in the event that people do collect them. Vision hardware benefit. This remains the same as it did in 2015. Blue Cross Blue Shield of Montana is processing our vision hardware benefit. A couple things to keep in mind. Remember last year we changed so that vision exams are now covered under your medical benefit. So that's an important thing to have done in order to make sure that your eye health is preserved. So we want to make sure that that benefit was enhanced. It's now covered under your medical benefit, so you don't have to purchase an optional coverage in order to get eye exams. But you can purchase the vision hardware benefit, which will help you pay for frames, lenses, and contacts. We do encourage you to, if you have questions, to contact us for information or Blue Cross Blue Shield on that. There is no need to find a network provider. Again, this is for a hardware benefit. All right, just a little bit about our rates and fees this year. So in aggregate for active employees, premiums will go up 3% this year over 2015. So from, depending on which of the medical plans you select and whether you cover family members or not, your premiums could go up between $4 a month and $57 per month. One thing that people may notice who are looking at the tiers where they cover children or families or spouses is we have done some actuarial adjustments in order to more closely align the costs of those benefits. Typically those are done on a periodic basis by our actuaries. So you will find that in some cases, for example, employee and children rates have not increased as much, where employee and spouse rates, which were priced slightly under the actuarial requirement, have gone up. For the non-Medicare retirees, in aggregate, rates will go up 7.6%. And so that means that premium increases range from $46 to $102 per month, depending on which medical plan you select and whether or not you cover dependents. And finally, for Medicare retirees, premiums will go up an aggregate of 7.4%. The range in premium increases monthly is from $19 to $69, again, depending on which plan you select and whether you cover your family members. For Medicare eligible retirees and for Medicare eligible spouses, you may wish to take a look at the Medicare Advantage plan through New West. The rate for that plan remains the same as it did in 2015. It's $196 per month. Benefits have changed some, so we do encourage you to visit with a representative from New West or attend one of our retiree presentations where representatives from New West will be presenting on the New West MAP plan and you can ask questions. Dental premiums and the vision hardware premiums remain unchanged from 2015. So those are the same regardless of whether you're an active employee or whether you're a retiree. Finally, here are some contact numbers and websites if you would like to talk to the various administrators. For medical, that's Allegiance, Blue Cross Blue Shield, Pacific Source, and MUS MAP. These are sources where you can contact them. They're also found on the back of your MUS booklet once you receive your booklet. For retirees who might be viewing this podcast, we encourage you to review your medical plan choices carefully. Again, there are 3 managed care options as well as the New West MUS MAP option. And we encourage you to attend a retiree presentation to learn more about those options and ask questions. We do encourage you to also contact your campus benefit office or the Central MUS Employee Benefits Office. If you have questions, we're happy to help you and answer whatever we can. Any forms for changes for retirees must be received by the date that your campus is specified, and they will let you know what that date for their processing cutoff is. If you do not intend to make any changes to your benefits coverage, you do not need to turn anything in or make any elections. You will roll over and keep the same options that you had in the prior year. That's for retirees only. For active employees with changes to choices, please watch for the campus mailings and information regarding the dates that you must submit any of your changes by or go onto your systems and make your elections. Be sure to make those changes by the cutoff date specified by your campus or you may miss out this year. A reminder that it is closed enrollment for spouses for fiscal year 2016. So without a qualifying event, you cannot add a spouse in 2016. However, you can add children up to age 26. If you don't submit any changes this year or you don't go in and make any elections, then you will receive the same benefits elections that you had in the prior year with 2 important exceptions. We cannot roll over a flex election. That's an IRS requirement. So you must make a positive election and specify a dollar amount each year if you wish to participate in a medical flex plan. If you wish to participate in the tax advantaged account, similarly, you must elect the tax advantaged account and tell us that you want it. Otherwise, we will not set up a tax advantaged account for you, and you will not be eligible for the $750. Remember that Flex is use it or lose it, so we do encourage people to be very careful about determining that. One thing that is important is flexible spending account funds and TAA account funds, if you have both accounts, will be coordinated. And the plan administrator will take money out of the flexible spending account first because it is use it or lose it. We don't want you to lose those funds, and the tax advantaged account funds can roll over, so those will be saved for later. If you have any questions, please, again, feel free to contact your campus benefit office or contact Central MUS Choices Benefits office, and we'll be happy to help you. We look forward to hearing your questions during the upcoming months, and we wish you well.